Welcome to The Explainer. Today we are diving straight into Costamare Inc., a company that's currently holding a massive secret, one that the broader market seems to be completely ignoring. We're essentially cracking open a case of deep, hidden value in the world of containership leasing. In today's market, everyone is so obsessed with future promises, speculative tech, and AI pipe dreams. So finding a traditional, physical asset that is quietly pumping out cold, hard cash, it's incredibly rare. And the numbers we're about to look at might just challenge everything you assume about how efficiently the stock market actually prices these traditional businesses.
Okay, let's look at this absolutely jarring contradiction. Costamare currently has an incredible $3.4 billion and guaranteed contracted revenue backlogging its operations. I want you to really let the weight of that number sink in for a second. What does a contracted revenue backlog actually mean in the real world? It means legally binding agreements. We aren't talking about projected revenue based on some hopeful sales pipeline, and it's definitely not a best-case scenario. This is locked-in, contractual cash flow stretching several years into the future. Even if the broader economy suddenly stumbles, that money is still legally owed to them. It is just so rare to see this level of guaranteed cash acting as a massive safety net under a company.
But here is where the math completely detaches from reality. Their current market cap is only $1.93 billion, trading at just $16.60 a share. We're looking at a scenario where the contracted revenue backlog is roughly 1.8 times the entire market value of the company itself. It's a fascinating disconnect, right? Imagine, just for a second, that you could buy a highly sophisticated money printing machine for $1.93 billion, and that exact same machine already comes with an ironclad, legally binding contract to print $3.4 billion for you over the next few years. That's literally the exact setup we are looking at here.
To solve this financial mystery, we're going to cover 5 key areas: the hidden value mystery, inside the business model, financial strength and valuation, navigating sector risks, and finally, the final verdict.
All right, starting right off with part 1, the hidden value mystery. Let's figure out why this huge gap between guaranteed revenue and market valuation exists.
We really have to ask, is Mr. Market pricing this company for guaranteed failure? The stock is currently priced as if an impending collapse is an absolute certainty. But does the underlying evidence actually support that fear? You see, the broader market often treats shipping stocks like they're totally radioactive. And to be fair, historically, the shipping industry is notorious for brutal boom and bust cycles. Companies tend to wildly overbuild their fleets during the good times, and then they go bankrupt when global demand inevitably drops. The market remembers those devastating historical bankruptcies. But when you stack that $3.4 billion revenue backlog against a $1.93 billion valuation, you have to wonder, is Mr. Market just deeply traumatized and suffering from severe sector bias, or is there a genuine catastrophe lurking just below the surface?
Moving on to part 2, inside the business model. We have to look past those sweeping shipping industry generalizations to see how Costamare really makes its money.
So, the crucial point to understand here is that Costamare is not a volatile spot rate carrier riding the daily waves of supply and demand. Spot rate carriers are at the absolute mercy of the market. Imagine you're a spot carrier. If global trade hiccups on a Tuesday, nobody needs your ships, and by Wednesday, your revenue literally plummets to zero, all while your massive operating expenses stay exactly the same. It is a terrifying way to run a business. Costamare, on the other hand, operates much more like a floating real estate investment trust, or a REIT. They own the physical assets, these massive container ships, and lease them out on long-term, fixed-rate contracts. They're a predictable toll collector, not some stressed-out day trader.
And who are they actually leasing these giant ships to? These multi-year charters are signed with top-tier, highly creditworthy global liner companies. We're talking giants like Evergreen, MSC, and CMA CGM. Why does that creditworthy label matter so much? Because when the global economy takes a dive, smaller operators might just default on their leases and walk away. But logistics giants like Evergreen and MSC have absolute fortress balance sheets. They can easily afford to keep paying their multi-year leases even in a severe, prolonged recession. This deeply embedded relationship with the world's largest logistics giants means Costamare's revenue is virtually bulletproof in the short term. It heavily insulates them from market panic.
And their recent history brilliantly illustrates a newfound strategic clarity. Pre-2025, Costamare had this messy, mixed fleet of different types of vessels, which really muddied the waters for investors. If you want a complicated mix of dry bulk ships and container ships, running accurate valuation models becomes an absolute nightmare. Pure-play investors hate that kind of complexity, so they just avoid the stock altogether. But having spun off their dry bulk division in May 2025, they are now a highly focused, pure-play container ship lessor. This singular focus simplifies the business model immensely. It makes that predictable REIT-like cash flow so much easier for the market and for us to analyze. Let's jump right into Part 3, Financial Strength and Valuation, and see what the hard numbers tell us. Let's slow down for a second and really look at what these metrics are screaming at us. The stock is trading at just 5.8 times earnings and at a 10% discount to its book value of $18.40. This suggests a deeply undervalued asset supported by a fortress balance sheet. Buying below book value is a massive deal. Book value is basically what a company's assets are worth on paper if you liquidated absolutely everything tomorrow. You're buying these high-quality, massive maritime assets for less than their underlying accounting value. And unlike a dying retail business that trades below book, Costamare's assets are actively generating a huge stream of profits. When you run a discounted cash flow model based on their continuing operations, the intrinsic value comes out to $21.50 per share. Yet, you can scoop it up today for just $16.60. Now, have you heard of the PEG ratio? It's a fantastic valuation metric popularized by the legendary investor Peter Lynch. The PEG ratio acts as a comprehensive value screener because it factors in a company's dividend yield alongside its price to earnings and its growth rate. Costamare scores a 0.74. That shows the market is completely ignoring its 2.8% dividend yield and its consistent earnings growth. Finding a PEG score below 1.0 in today's generally inflated market is incredibly rare. It's essentially a bright green light for value investors, definitively signaling that the stock's future growth and its generous dividend payout are being heavily underpriced by Wall Street. Let's talk about cash. Their estimated $290 million in free cash flow comfortably covers their $76 million preferred and common dividend obligations with massive headroom to spare. Let's break down why this matters so much. A high dividend yield is often a classic value trap if a company doesn't actually have the operational cash to pay it. But looking at free cash flow yield tells you the actual hard cash left over after all operations and maintenance are fully paid for. They have an estimated free cash flow yield of roughly 15% at current market caps. That is the very definition of dividend safety. They aren't starving the business to pay you. They're generating so much excess cash from those multi-year contracts that the dividend is practically an afterthought for their balance sheet. Okay, Part 4, Navigating Sector Risks. As diligent value detectives, we have to play devil's advocate. What's the catch? Let's run a quick red flag scan. While they easily pass major hurdles, like avoiding reckless empire-building serial acquisitions, and they do boast a very healthy $590 million in overall liquidity, we do have to watch their cash reserves closely. Those reserves actually fell from $745 million in 2023 down to $520 million today. Now, management attributes this drop to post-spin-off working capital and strategic fleet investments. Is that a valid excuse? Actually, yes. Actively investing in your fleet is absolutely necessary to secure lucrative future leases so they aren't just setting money on fire. However, in a highly capital-intensive industry like shipping, any shrinking cash pile demands our ongoing attention. It's a key watch area for us, even if it's not an immediate panic button. The biggest existential threat to this business model isn't an overnight crash. It's much more like a slow-moving storm. Imagine a severe global tariff war or a deep recession hitting right when their current, highly lucrative contracts naturally expire in 2 to 4 years. Because they are a pure-play lessor, if the prevailing spot rates have crashed by the time they need to sign new multi-year contracts, they'll be forced to recontract their entire fleet at rock-bottom rates. This exact scenario played out in the brutal 2008 and 2016 shipping downturns, where lessors were caught empty-handed and forced to sign terrible deals that barely covered operating costs. That historical trauma is the cyclical risk that keeps the market up at night, and frankly, it's the primary reason for that heavily discounted stock price today. Which brings us to Part 5, the final verdict. Let's bring all these clues together. While the company might lack a wide, impenetrable economic moat, it perfectly fits the late Charlie Munger's criteria of an acceptable business at a good price. And crucially, it is supported by heavy 60% insider ownership from the Konstantakopoulos family, who have successfully steered this ship for decades. This skin-in-the-game concept is just absolutely vital. When the family running the company owns the lion's share of the stock, their personal wealth is tied directly to the share price. This practically prevents management from doing reckless things, like over-leveraging the balance sheet or cutting the dividend just to hit some arbitrary quarterly target. Their incentives to protect the business are perfectly aligned with yours as a retail shareholder. By averaging our discounted cash flow and market enterprise value models, we arrive at a highly conservative base intrinsic value of $20.65. With the stock sitting around $16.60, This means it's currently trading at an unwarranted 20% discount. That 20% is what value investors call your margin of safety. A margin of safety is essentially your financial cushion against being wrong. It means that even if management makes a minor misstep or the global economy dips slightly worse than expected, the market has already priced in that bad news. You're protected on the downside simply because you bought it so cheaply to begin with.
So here is the actionable takeaway for us. If you have the patience and can tolerate the inevitable cyclical volatility of the shipping sector, buying below $16.60 offers a very strong margin of safety. Combining the capital appreciation potential with that remarkably safe dividend, you can target a realistic 6 to 8% total annualized return compounded over a 16-year horizon. Moving forward, you'd want to look at reasonably trimming your position if it hits the $22 to $24 range, and seriously consider a full exit if the broader market ever gets euphoric and pushes the price above $30.
And there we have it. We've thoroughly cracked the case on Costamare's hidden value in this explainer. It's a phenomenal example of how looking past lazy sector stereotypes and focusing intensely on hard contractual cash flows can reveal incredible opportunities that the rest of the market is just completely ignoring. But our investigation into the market doesn't stop here. Drop a comment below and let me know, which stocks would you like me to analyze next? I'll see you in the next explainer.